G'day everyone, Jackson Milan, the Wealth Mentor,
Sam Panetta.
and we're here for another episode of Ask Aureus Anything, our weekly live Q&A, where we talk about all things current events in business, finance, wealth, everything in between. We answer your questions and we do other things.
Normally Jackson dances. He didn't dance tonight. He mustn't be in a very good mood today.
Nah, I'm always in a good mood. This is the best day of my life.
This is the 41st episode, so we've been smashing out 40 hours of Ask Aureus Anything. It's provided us with a lot of content on our social media pages.
Yes.
We've answered a lot of questions. We've bantered with a lot of viewers. It's been phenomenal, actually.
And I wonder how many of those Ask Aureus Anything that Shane Black's attended. I need to do some research.
He'd have to have like
stats.
a 95% strike rate of attendance.
Well, so we are going to cover off some cool articles, some stuff that's in current events, stuff that will affect you on your wealth journey. So hopefully it'll give you an opportunity to learn some stuff and hopefully apply it to your life. Now,
for anyone who doesn't know how this works, if you're sitting here and you're watching this episode live and you have comments to make about what we're talking about, please post. If you have any questions, anything that you want answered that's got to do with money or wealth, property or business, any of those sorts of things, post your questions there. We're actually a wealth of knowledge. There's a lot of knowledge in these two brains. So we're here to help you guys and sort of demystify everything around money.
Yep, so make sure you get involved. We want to make sure that you participate, and our friends over here are participating behind the camera, just giggling, which is fantastic. We've got a great office environment here, and we're all enjoying ourselves. And on that point, we're actually going to be having a new location for our content in a couple of weeks, aren't we, Sam?
We will. So we've recently acquired some more office space here in the Lifestyle building in Brookvale, and we're going to build it out a little bit. And it's going to be a meeting room because we're having so many meetings now. We're running out of meeting rooms, so we needed some more space. And it's also going to double as a studio for all of our filming. So all of our video content that we produce, all of this Q&As, the podcasts that we do, much to Jackson's delight.
This is my dream.
It is his dream. It doesn't cost very much, so that's my dream. But it's going to be cool. So in 2019, we're going to have a new spot. We're going to have a cool background that we're going to do.
The Aureus Studios.
The Aureus Studios. We're going to have some cool guests come on the podcast. It's going to be pretty fun.
It's going to be fantastic. So let's dive into the meat and potatoes.
General advice warning first. I don't want to go to jail. I'm too skinny. Anything that you hear tonight is general advice only. It's not tailored to your situation. So before you go away and action anything, make sure that you consult a professional like this bloke.
Yeah, and if you do want specific advice about jails, we can cover that if you like.
And join the Wealth Mentor community. It's a free Facebook community where we share heaps of free content every single day to keep everyone up to date with what's going on in the world of finance, business, money, and property.
And also share our stuff. Just do it. There's a little button there. Press it. Just see what happens. Just allow curiosity to just take over you and consume you, and just click the button. It'll be worth it, I swear. All right, so let's get into the articles.
All right, so this one here, this was massive in broker land, in the land of mortgage brokers where I live. It's probably the biggest thing that's happened in quite a long time. And the headline to the article is why CBA dumped its bold plan to stop paying mortgage broker commissions. All right, so let me give you guys a little bit of background. As a mortgage broker, I do not charge the clients a fee. The bank pays me a commission for writing the home loan. So for essentially doing all the work on their behalf, they pay me a commission and an upfront commission and an ongoing commission. Now, CBA had this plan to scrap paying mortgage brokers their commission and reducing it to either a referral fee or a fee for service. So where the mortgage broker actually charged the client for brokering their home loan. Now, this would be sort of detrimental to the mortgage broking industry. It would reduce the amount of revenue that mortgage brokers produce considerably. So CBA were going to do it, and they were about a week away from pulling the trigger, and this all came out in the Royal Commission. But they thought that they would lose their competitive advantage because the other banks wouldn't follow suit. They wouldn't stop paying brokers their commission, and essentially what would happen is just everyone, or mortgage brokers, would stop working with CBA. So they pulled out at the very last minute, and they got a little bit of trouble for this because the Royal Commission has said, well, if you thought that was the right thing for your customers, you should have done it anyway, whether or not you were going to lose business out of it. So it weighs the question, are they doing it because it's in the best results of their customers, or are they doing it because it's a way of cutting costs? And look, CBA has come back to this and said that mortgage broker commissions should be banned completely. It should be law, and all banks and all lenders will have to abide by that and stop paying mortgage brokers commissions. Now, this would be a great result for the banks, because without brokers, there's no competition between lenders. There's no one to be that middleman and make that bank compete against that bank. So who loses out here? The consumer. And we're going to find out in February of 2019 whether this did go ahead or not. And until then, it's everyone's sort of in the finance industries on the edge of their seats.
Yeah, this is the thing, Sam. Banks don't do anything unless it's going to add value to shareholders and in turn line their own pockets. You'd think, okay, if there's commission in a product, obviously that gets priced in, all right? So the banks have understood what it costs them to be able to manufacture a product, distribute a product, make a margin on it, and also pay the distribution channels like a broker. So you'd think, okay, we cut out the brokers, meaning that, okay, then we can reduce the interest rate that we charge. No. Banks aren't going to do that. They'll keep interest rates the same. They're just going to absorb that themselves. And ultimately, it's going to line their own pockets more. So consumers aren't going to be better off. Consumers aren't going to be able to navigate the complexities associated with what makes one mortgage or one bank different than another. And it's going to have a huge flow-on effect if this happens. This would not only destroy the mortgage broking industry, but this could potentially be the catalyst to result in the collapse of the property market.
Absolutely it could be, because it's, if you go to your bank, you might not be able to get the money to buy an investment property or buy your home because it doesn't fit your bank's policy. Now, when someone comes to me and they bank with CBA and we've got to get them a home loan, 9 times out of 10, we're not doing the home loan with CBA because it doesn't fit the client's requirements. We're taking them to a different bank. So you imagine those other 9 people, if they went direct to the bank says no, they assume the answer's no, and they're done, and they're not going to be buying any property.
Or they cook their credit file in the process,
trying to shop
going
around
from bank to bank.
Absolutely. So this is look, it's a very interesting space. I spoke with a lot of bankers today at the Commonwealth Bank, and they were getting abused by mortgage brokers, which doesn't make any sense. It's not their fault, but those guys their job's on the line too, because they support the broker channel. So without a broker channel, their jobs are gone. And the thing is, has anyone actually tried to go directly to a bank to get a home loan? What was the service like? What was the bloke you're talking to fresh out of school? Did he know what he was really doing? I'm not too sure. So it's one of those things, like it's common knowledge in the industry that when a banker is really good as a broker, they just go out on their own and be a broker. So all the top tier loan writers in the industry are mortgage brokers. They work for themselves rather than working for the bank. And whoever's left working at the bank is sort of the ones that can't rise to the pinnacle. So look, it'll be interesting if they do it. The industry will change a lot. I can't see any positive impact on the Australian economy or Australian consumers.
No. So we'll have to wait and see. So for those of you who are property owners or looking to buy a property, what do you think about commissions being paid to a broker? If the product that you're acquiring costs you no more, that you could walk into a bank and get it. However, by going to a broker, you have the added service of getting unbiased advice about understanding where you're actually going to get the best possible deal, education around what's available in the market. Is that of value to you? or do you see it as something that actually scares you away, that you don't like people receiving a commission on a product? There's obviously people in different sides of the fence, so we'd be interested to hear what you've got to say. You're not going to offend Sam. He's heard it all before.
No, I don't get offended. Even when Sal opens the door in the middle of a Q&A session, I still don't get offended.
Yeah, we don't get offended with that. Studio, Sam. See? This is the reason why we're going to get a studio. To keep Sal out.
All right. Tell us what you think.
Moving on. So the next one, this is a very, very interesting article. And this is something that I've been talking about for years. And it's interesting to see it's something that actually got into the press. So the article says, estranged son wins $75,000 from mum's estate despite being written out of the will. Now, this is something that's really interesting. Now, estate planning in Australia is a very particular field. And ultimately, even though you've got something in black and white, it is your wishes, there is opportunity for people to contest your wishes and win. Now, ultimately, people think this is ridiculous. They can't see how this happens. I've taken the time to document my wishes. I've put it in writing. They should be followed, but it doesn't work that way. And there is essentially a piece of legislation called a family provisions claim under estate law, which allows any eligible beneficiary an opportunity to make a claim because they believe that they haven't been appropriately provided for in the will, or they've been written out completely. Now, in many cases, those people are successful. And the reason for it is that, one, people who pursue these claims, if they are successful and they're making a legitimate claim, they actually fund their costs from the estate, meaning that there's no barrier to entry. It's not like you have to weigh up around the costs that you may have to invest to pursue a claim. And secondly, there are a lot of lawyers that market no-win, no-fee services, meaning that you've got nothing to lose. And because of these perfect storm that's been created, there's lots of people that do dispute wills, particularly if they haven't been written comprehensively. And because of this, they don't stand up in court and money gets paid to people that shouldn't. Now, can you avoid this? Not with 100% certainty. So how long is Sal going to take to shut that door?
Sal's been opening and shutting that door
for about 10 minutes.
I don't know why it's so
He's
hard.
like a master of opening and shutting doors. It's phenomenal. I'm intrigued. I lost what I was talking about. Anyway, wills.
Estates.
We're talking about estates. So there's no 100% certainty. Anything can be contested through the rules. However, if you want to get a solid estate plan, it's about making sure that you work with an estate planning specialist, get them to help you document your wishes. And if there are going to be any issues, potential people who may dispute your wishes, people that you're writing out of the will, if you've got a blended family, if you've got complex situations where there's a lot of money at stake, there are safety nets that we can put into place to ensure that you can stand the maximum chance of ensuring that you protect your estate and it goes where it's supposed to go. Now, in a lot of these cases, it is actually better to include a nominal gift as part of the estate. So instead of this lady leaving absolutely nothing, even saying in the will that the estranged child would have got $10,000 and then gone on to explain why, it probably would have stood more of a chance of actually not paying out the $75,000. In any case, got to get the right advice, make sure you get the right documents. You're not around to fight your battles anymore, so you've got to spend the money to get this done properly.
I've seen a lot of this, man, and it's actually horrific to see. You see a lot of people when someone dies and there's money around, they come out of the woodwork and they want to sort of take what's not rightfully theirs and what they haven't earned. And so is there anything people can do to protect themselves against this?
Yep. Get the right advice. And unfortunately, like anything that has to do with the law, legal structures, binding agreements, wills, you don't know how good they are until you need to use them. And when you need to use them, sometimes it's too late. So you've really got to take a bit of a leap of faith, get the right advice, deal with specialists, people that know what they're doing, and spend some money to get this done properly. We work really closely with a group of estate planning specialists, and to get a comprehensive estate plan done probably costs about $2,000. And it's something that if you get it done right, it can last you for a very long time. And it can give you peace of mind to know that all of the complexities in your situation have been navigated and you've been given the right advice to make sure you can protect what you got. In saying that, it doesn't mean that your dog walker can come and make a claim on your estate that you're not related to, that you met once. They minded your dog back in 1982. There are legitimate beneficiaries that can make family provisions claims. So have peace of mind that not anyone can just walk off the street and have a crack.
What do you guys think? Have you guys seen it? Have you guys seen someone pass away in the estate being left over and the family destroy themselves over whatever is left? I don't know. I think every family's probably got a story where they've heard it or they've seen it happen. So
yeah, it happened to me personally. I wrote about it in my book. It can happen to everyone. Money makes people do stupid things.
Nah, I disagree with that statement.
Money.
Unearned money makes people do stupid things. I've never seen someone bust their ass for 50 years, get rich, and then go do stupid things with the money, right? But I have seen bludgers who've never earned nothing come into a lot of money and then go do stupid things with it. So unearned money makes people do strange things.
Yeah, I agree with that.
All right, so what do you guys think? What are you about people having a crack at estates? Tell us. We want to know your deepest secrets. All right, so the next article, and it's something that is not being talked about as much as it probably should, but it will be talked about more over the coming years. One big twist in Labor's negative gearing plan. So let me, guys, give you the rundown. So negative gearing, for those of you who don't know what it is, it's essentially, let's say you own an investment property that's worth $500,000 and you earn 20 grand in rent that year, but it costs you 25 grand to hold that property. You've made a $5,000 loss from holding that property, and then it can reduce your taxable income by $5,000, so you end up paying less tax. That's essentially what negative gearing is. And a lot of property investors utilize it to reduce their taxable income, to buy growth assets, and they essentially get some tax benefits out of it. So Labor, who's tipped to win the next election, is basically one of their flags is that they're going to scrap negative gearing. And the general consensus is that by scrapping negative gearing, you're removing one of the reasons property investors invest, hence you'll have less property investors. So what you're probably going to see is rents increase and the prices of property decrease. And this happened in America when they got rid of negative gearing 30 or so years ago, and property went from a capital growth asset to more of a cash flow yielding asset. It changed the dynamic, and property markets over there didn't go up for about 10 years. So it really had a profound effect. I don't know how big the effect would be here in Australia, but it will do something. My personal opinion, I'll play it either way. Right. So if negative gearing stays, more benefits for property investors, more reason to invest in property. If negative gearing goes, you're going to see more first home buyers get into the property market, which I don't mind that. I remember when I was a first home buyer, it was a really positive thing in my life. So I wouldn't mind seeing first home buyers having up the crack.
There's a big twist here. So in the proposed frameworks that Labor is putting forwards is that they're looking to get rid of negative gearing, meaning that if you have a capital, an income loss on a property, you cannot deduct it from your earned income or business income. However, if you have a portfolio of properties and you have a property that is positively geared, you can use a negatively geared property to offset the positively geared property. So for example, let's say you've got a property with $5,000 a year positive cash flow and a property that has negative $5,000 a year cash flow, then that would mean you pay zero tax. So this is actually going to be a loophole for sophisticated investors. And this is an opportunity for you to get the right advice around how you structure your portfolio of staggering your properties. So you have one positively geared property and potentially one negatively geared, and you stagger it so you get to a point where you essentially achieve the same outcome as if negative gearing already existed. However, you're just being more tactical about it. So if that is the case, I really think it could potentially be another factor that increases the separation in wealth in Australia.
Yeah, between rich and poor, because that's a tactic that only the rich could use.
Correct.
And the poor and the middle class wouldn't be able to utilise such 100%. A tactic. And it goes even deeper. I believe it runs into shares as well. So if you have a share portfolio, you can that yields high, you can offset that against your losses made on the rental. So that's a sophisticated investment strategy as well. You're going to see these high income earners buy these high capital growth investment properties, buy a ton of high yielding shares and offset the difference. So it's one of those things. There's always opportunity there, but as Jackson mentioned, the divide between wealth and the separation of wealth will only increase.
100%. Yeah. So it's just important to be mindful of that. Now, the next one here, I guess before we move on, what do you think of negative gearing? Do you think that it's going to have issues when it comes to the property market? Is this going to have a flow-on effect? And I guess what are your views? We're not getting any comments. I'm not sure if we're having issues again, or whether no one wants to talk with us.
There's one comment.
There's
Uncle
one
Sam,
comment.
hello,
There
hello,
we go.
hello. Thanks
Fantastic.
for joining us.
I love that. Thanks for contributing.
Oh, something's not
It's on the
working.
fritz. All right. So next one. Coles Group lists on the ASX with an opening value of $16.6 billion. So
sort of cash.
Look, Coles has been passed around a little bit over the years. Coles originally listed, and I think it was back in the 80s, mid 80s, then merged with Coles Myer, then got sold to Wesfarmers, have now done a demerger with Wesfarmers and have listed independently themselves. Now, what does this matter, and what does this mean? This is something that can potentially have a flow-on effect to us as consumers. Now, first things first, interesting facts. Coles demerger was valued at $20 billion, and their current valuation on the stock market is $16.6 billion. So in actual fact, they've lost money as a result of this process. So when you're thinking about it, it'd be interesting to understand between the lines of where did the decision come from? Was it Coles management that was trying to drive them being able to run independently and not be caught up in the whole FMCG space of what the Wesfarmers Group does? Or was this something that Wesfarmers feel that they're not an area where they want to continue to be invested in and essentially just wanted to toss it out with yesterday's garbage? So it's going to be interesting to see what happens. Now, when we look at the analyst's perspective, and we need to understand what drives share price. And share price is based on intrinsic value and also about what the market perception is on the future value of the shares. So we've started to see a company that's demerged at $20 billion, currently trading at about $16.6 billion. So we're talking about, 2.5%, 3%? Oh, it's a pretty significant reduction in valuation.
It's monstrous.
So in terms of dollar figures. So it's about, okay, how long is it going to take for us to make that up? Now, when we look at it, and now it's on a kind of even playing fields of Coles independently listed, Woolworths independently listed, the analysts say that Coles is going to trade at a discount of probably about 10 to 15% compared to Woolworths because of less stores, a poorer distribution network, and supply chain. So all of these things, look, it's more so important to know. Some people will go and buy the stocks because they like the brand. However, when it comes to investing in anything, property, shares, you have to understand what makes its value. And I think that having Coles as a standalone business, it's going to be much easier to determine its value.
Yeah, because Wesfarmers as a company owns a lot of different stuff.
100%.
They're in mining, they're in all sorts of different industries, right? Maybe they don't want to be in groceries anymore. I don't know. Maybe Aldi, we spoke about them the other day, has scared them off. I'm not sure. But the thing here is for the individual investor is that these shares, so the stocks in the share market, they're real companies. Do you know what I mean? And to see growth in the share market over long periods of time, it comes from the growth of these companies and the creation of wealth as the business value goes up. And that's what Jackson said. They essentially took a 20% haircut on the value of the business. That's pretty significant. It's like someone paying $1.6 million for a $2 million property. So rightly said, you know, why would they do it? I don't know. It was overwhelmingly supported by shareholders. So there was some reason they done it. Look, this is high finance. The average punter probably can't get too excited about this, but it's buy shares. You'll be right.
Buy shares. Now, once again, I think this is about stressing the fundamentals. If you don't understand how to determine intrinsic value in a company, to understand whether this is a good thing or a bad thing from a financial and a quantitative standpoint, don't go out and buy shares. You should be considering a diversified approach that doesn't require your expertise, and look at accumulating an index fund or an ETF, an exchange traded fund that offers you a diversified approach. For example, instead of going and picking Coles, Woolworths, BHP, CBA, whatever, go and acquire a ASX 300 index fund, which gives you the top 300 companies in Australia. Or you can get a diversified fund that gives you exposure across the whole world. These are just some options to consider. That means that you don't have to be picking stocks. We don't pick stocks, do we, Sam?
I don't pick stocks.
No.
It's number one, it's boring. Number two, too busy to pick stocks. Belma's here. Hello, Belma.
G'day, Belma.
You know, the index style of investing, it's unless you're like the top 1% of stock investors, stock pickers, most people are horrible stock pickers. It's lazier and a more profitable approach to investing. That's what I like, lazy and profitable. So it's that's what we do here. That's what we practice. So we're not out picking the difference between Coles and Woolworths. Probably never will.
Where do you shop, Sam?
I don't shop, mate. I've never been to the shop.
He's never been into Coles or Woolworths in his life.
Where I shop with my wife buys the food. I don't know. I genuinely don't know where we get our groceries from. I get mine from the fridge. How they get to the fridge, I'm like...
He's not sure. They just miraculously turn up.
It's like one of those magic fridges that the food... Remember that Tim Tam ad? That's what my fridge is like. The food just continues to go.
At least I just need to thank you for keeping Sam alive for all these years. You've done a phenomenal job.
Keeping me fair.
How he's still alive and kicking, I have no idea. It's credit to you.
If Elise left in 3 days, I'd be
dead.
Homeless at DY bus
You'd be
stop.
knocking
I'd have
on
no food,
mine.
no clothes.
Jackson, how do I boil an egg? I'll teach you, mate. Let's hope it doesn't get to that, all right?
Where do you guys shop? Do you shop at Coles or Woolworths? Tell us. Tell us where you shop.
Food miraculously appear in your fridge like Sam. You got one of those new state-of-the-art fridges.
They're going to build that one day. They're going to build fridges that when there's out of a certain ingredient, it'll order more and they'll deliver it.
I love that.
They will. Someone told me, futurist. All right. So the next article is Westpac's $35 million responsible lending law settlement with the ASIC has been rejected by the judge. So essentially, Westpac done some unscrupulous lending. They got in trouble for it by ASIC. They were issued a fine. They were issued a fine by ASIC of about $35 million, and then the judge has overturned it and essentially said, no, we're not going to charge you guys this fine. Look, I'm in two minds about this. Like, I think when someone does something wrong, they should get in trouble for it. But on the flip side, when it's a massive business, how do you control every single punter that works for you when you've got 50,000?
Well, this is a big policy, right? So let's talk about it. So back in the day, Sam, run us through how a bank would calculate household spending.
So essentially, there'd be HEM, right? So HEM is like data-driven minimum living expenses for that particular person. So let's say, a one-person household in Mossman on a certain income would have a different HEM to a five-person household living in Penrith, and so on and so forth. So there was different HEMs for different, where people lived, how much they earned, and what the family formation was. And essentially, when you wrote a home loan with a particular bank, you had to ask the client, what are your monthly living expenses? And the client would say $2,000 or $2,500 or $1,000 or $1,500. And it was essentially, they just throw a round figure at you because 9 out of 10 people don't know what their living expenses are. They give you some sort of estimate. So what's happened now, and most of the time it would fall below this HEM. So it would fall below like this minimum requirement. So a client says, it costs me $1,000 a month to live. Bank says, no, it costs you $1,662 to live. And then that's the figure they would use with sort of no further articulation around how much it costs these clients to live. Now, we do full budgets with every single one of our home loan clients, and we itemize them and we break them down into 10 or 20 different categories, and then present that to the bank. And that's sort of the minimum standard now. And that's probably what it should have been for quite 100%. A long while. And it's one of the reasons that people can't borrow as much as they used to borrow, because everyone's real living expenses are now being articulated, not some rough estimate, and it's after you actually go through your budget with someone, you realize that it actually cost me more to live than what I initially thought.
And this was the reason why this came up. And I think that personally, they should have enforced the fine. I think that it's really I think probably one of the reasons why they overturned it is that rules have already changed. They've already tightened the belt because of changes that have been driven by APRA. And ultimately, this is something that it was really just going to be a fine just because of what the way things used to be. And I think this was the gold standard for all banks, wasn't it, Sam?
Yeah, everyone operated in this manner. I think the first to sort of bring in the budget, the itemised budget, that was NAB. Actually, they'd been doing it for a very long time, and now it's sort of like you need an itemised budget if you're going to go get a bank loan.
Yeah. So look, what do you guys think about this? Do you think that when these things do come up, even if all the banks are doing it and one bank's been isolated, do you think they should get hit with a fine? What do you think about this being overruled? When you think about it in the grand scheme of things, $35 million for a big four bank, it's not a lot of money.
It's not a lot of money.
They pay it out of their back pocket. Here you go.
Throw it at the punter judge. But it's one of these things. It's hard because, look, I guess you can say that it's not one individual person because it was a structural thing. It was something coming from the top of the bank. So it would have been some executive making the decision to do it this way and to change the way they do it. Look, it's changed for the better. It's changed for the better, and this is why when Americans come over to Australia and they say property prices are too high, they're going to collapse. They don't get it. In America, they had no doc loans. You don't even know job loans. They called them ninja loans. No income, no job applicant. So people will go into the bank saying, I can afford this loan, and they give you the loan. And they wonder why the property market collapsed. In Australia, it's just not that way. They're very strict.
No ninjas here.
There's no ninjas, only wizards. and they're very strict, and that's going to keep the banking system strong, and that's going to keep the property market strong over long periods of time. You're going to get times like now where it's soft. It's a good opportunity. Buy some houses.
Buy a house.
Buy a house.
All right. Cool. So now we're going to go into some questions. So for those of you who are watching, if you have any questions, hit them with us. Do you want to ask Sam questions about what he has in his fridge? Although you probably wouldn't know. Whatever it is around business, wealth, finance, anything in between, feel free to hit us with your questions. However, we have received some questions through the week, so we will jump into those and talk through them. So the first question is, should the big banks still be the foundation of my share portfolio? Now, this is interesting. You've got to be mindful that all the big four banks are in the top 20 stocks in Australia. If you go and buy, say, for example, previous example, the ASX 300 index, you are going to have a very large component of that index made up by the big four banks. Now, should you be going out and buying big bank shares as a standalone right now? And this has been a strategy that many people have used for a long time, particularly retirees who have been looking for income, because the banks have typically always paid high dividend yields, have been consistent, have had good growth, and have provided some pretty good outcomes. Now, personally, I think the big banks are overvalued. And I think that there are going to be some key considerations moving forwards in terms of what is done with dividends into the future. So for all of those things, I don't think that, once again, you shouldn't be picking any stocks. You should be diversifying using index-based investing. And ultimately, if you do have, say, for example, the ASX 300, you've got and a wide variety of other companies in that 300 to buffer against what may happen if the banks do suffer whatever comes into the future. So I think you really need to be questioning it. You can't expect the same old tricks are always going to work. I wrote about this in my wealth management chapter of my book. And don't just continue to be a one-trick pony. So really try and shake it up, look for other opportunities.
Here's the thing with index investing that everyone forgets about. So, whether it's the top 20 companies or the top 50, top 100, top 200, top 300, it's the top companies, right? So the underperformers drop out of these particular indexes and the new stars, the up and coming stars come into the indexes. So that means that whatever index you're buying, if it's the 300, the 200, however low you want to go, you're continually buying the best companies or the biggest companies in Australia. And what happens to the best companies? Well, they normally become the biggest. So over time, you get rid of the stragglers and you continue to accumulate the growing bigger businesses, and that creates more wealth over time.
Exactly right. So you're basically just averaging out and you're betting on the best companies that exist. So so that's how you de-risk your portfolio.
Absolutely. All right. If you guys have any questions, we only got one more, so you better ask them now. Talk now, or forever hold your peace. So, question this week, got a property question. It's my dream to buy a beachfront home. However, they are so expensive in Sydney. I was thinking to buy in smaller towns like Jervis Bay or Noosa to get better value for my money and move there when I retire, renting it out in the meantime. Is this good thinking? I don't know. It depends how far you are out from retirement. But if you're 30 and you think that you want to retire in Noosa, so you buy a property there today, do you still want to retire to Noosa in 40 years' time? I am completely unsure, and I don't think that you should be buying an owner-occupied property for 40 years in the future and having it as an investment in the meantime.
No.
I don't
even know what I'm doing next week. I'm going on holidays next week. I haven't planned anything. So who knows what I'm going to be doing in 40 years? You know what I mean?
Yeah, look, I'd be segregating. Is it an investment? If so, buy the best investment property that you can afford. Is it going to be your home? If so, buy the nicest home you can afford, right? I wouldn't be mixing the two. That's
very
totally detrimental, and it makes it too hard to make a good decision.
100%. There are destinations and there's vehicles. A principal place of residence, a retirement home is a destination. This is a place, something that you work towards. And a vehicle is something that you use to get you to the destination. You can't have them both one and the same thing. So once again, you need to define what are your financial goals and what are your lifestyle goals. This seems to be a lifestyle goal. And it's so far away, depending on how old you are, of course, that lots of things can change. Even if you are approaching retirement, if you are getting closer, you want to be able to secure that property now and be able to have it rented out and then move into it later. That can work fine. However, it's just about understanding what is your exit plan. If you are going to buy that property using debt, do you want to carry that debt into retirement? How are you going to be able to pay off that debt by the time you retire? Are you going to sell and downsize and use the proceeds from that to be able to buy, to pay that property out? Or if this is going to be your first property, then what's your exit plan? So you really need to crunch the numbers on this and understand, because there's more to it than just buying your place in Noosa or Jervis Bay, and you really need to have a strategy to support you.
We see this a lot, right? People who they go on a holiday, they go somewhere nice like Noosa, and they're like, you know what, I'm gonna buy a holiday home in Noosa. I'm gonna buy an investment property.
It's great.
It's very romantic. Or they go skiing and they invest in like a holiday share scheme where they get to go there for 5 days or 4.9% of the year or whatever these things are. Typically, they make really bad investments, right? If you want to go on a holiday, you don't need to buy a $500,000 holiday. You need to go there every year, pay the interest on it, pay the maintenance on it, go to the same place every year for the next 50 years.
Go on a phenomenal holiday for 20 grand.
Go on a holiday. Go somewhere different. Invest your money in the best investment that you can. And then, you know what? You're going to make more money and you can go rent that cool place in the snow or in Hawaii or something like that. Go stay at a hotel anyway so someone else can cook the food. Don't worry about it. You're going to go there and cook your own food.
I think from all of the places I've been to, the maximum amount of times I've ever been back to one place as a holiday has been twice.
Yeah, there you go.
So, like, I couldn't think of anything worse than going back to the same place over and over again. It's like Groundhog Day. Go live your life. Go do nice things. Eat different food. Meet new people. Have new experiences. Don't tie yourself down. Because when it comes to retirement, it's about flexibility and it's about not tying up all of your capital. Personally, I'm just going to be a drifter in retirement. I'm just going to float around.
You're half a drifter now.
I know. I'm turning into like a traveling gypsy. We're gonna have long, like white hair, white beard. It'll be great. It'll be phenomenal.
All right, guys.
Hope you've enjoyed Ask Aureus Anything. If you've got any questions once we do go offline, feel free to post them up. We will come back to them next week, and we will see you. Actually, we're not going to see each other next week. I'm going to be in Cebu catching up with our offshore team. So I think we're going to do a week break, and we'll catch you in a couple of weeks.
All right, thanks, guys.
See you
Enjoy
later.
Wednesday.